DP World, listed on the Nasdaq Dubai Exchange, has reported first half 09 volume growth across its terminal portfolio. Across the 49 ports, DP World reported first half volumes of 20 million TEUs, slightly below our estimation of 20.6 million TEUs. This represents a year-on-year decrease of 13%, in line with the conditions reported by industry consultants Drewry and also World Growth Standards. Including 13.6 million TEUs worth of expansions over the last 12 months, DP World now has total port expansions across the world of 37.6 million TEUs. Just to recap, a TEU is equivalent to a 10-foot container, and this gives us an indication of the volume of containers with which DP World can handle through its ports. Including 13.6 million TEUs worth of expansions over the last 12 months, DP World can now handle across the total group 37.6 million TEUs, implying that given that they are currently using 20.6 million TEUs across the group, the capacity rate is around 53%, which reflects the weaker shipping conditions around the world at the present time. Despite cutting back 50% of terminal expansions given the weaker world trade conditions, DP World has progressed with several terminal expansions including Doralade, Djibouti and 2 new ports in Algeria. Looking forward, over the next 12 months, the company is continuing with expansions in China, India, Peru and 7-8 other locations around the world. This is likely to continue to strengthen DP World's terminal base worldwide and increase its market share at a time when many of its competitors are not expanding at all. Furthermore, the next core catalyst for the stock appears to be tangible signs of an increase in world trade, and indeed, at present, economic growth estimates for 2010 are trending positive. Given that trade growth normally outperforms GDP growth by 3 to 4%, we can see strong upside in DP World earnings for 2010. We anticipate that net profit will increase by 23% during 2010, underpinning a strong share price rise towards our target of 48 cents per share versus the last trade of 36 cents per share. Emaar Properties, listed on the DFM, reported a second quarter loss of 1.3 billion dirhams. This is including a write-down of its US subsidiary JL Homes of 1.7 billion due to its bankruptcy. Excluding this abnormal item, operating profit decreased by 67% to 442 million year on year, however actually stabilised from the first quarter of this year, and therefore we are thinking that Emaar's earnings is bottomed out from an operating perspective and there is some upside over the next 12-month period. Emaar continues to derive revenue from Dubai Mall, Arabian Ranches, Burj Dubai being handed over during the second half, all of which we expect to continue to contribute to earnings over the next 6 months. Internationally, projects in Pakistan, Saudi Arabia, Syria and Jordan continue to draw revenue as phases progress. Emaar's core offshore project, the King Abdullah City in Saudi Arabia, covering 168 million square metres, continues to progress at a foundation level, and we expect earnings to contribute over the next 18 months. To summarise, Emaar's operating result was in line with expectations. However, adding in the abnormal from JL Homes means that the net result was very weak. Given the fact that Emaar's consolidation with Dubai Holdings is yet to play out, we believe that the share price will continue to be volatile over the next 6 months. Trading on a low PE of 3 to 4 times 08 earnings, much of the bad news is factored into Emaar's share price at the moment, and therefore we think that there is some upside as long as general market trends remain positive in the UAE. Also on the plus side, the clearing the decks of the company's exposure to JL homes gives the company a good platform to move forward and look at other markets again, such as India, where it's looking to offload part of that venture into an IPO, which would relieve a valuable cash flow back into Emaar's business. Key upcoming catalysts for Emaar include guidance on the Dubai Holdings consolidation, guidance on what's happening with UMLAC that is currently suspended, guidance on the Indian IPO, the timing and how much, and also what's happening with the Dubai property market. Over the last 2 months, Dubai property prices have stabilised. However, many of the major projects still remain on hold. We think that with potential for the property market to stabilise further during the second half, more projects will be reinstated and therefore property earnings will increase. Dubai Islamic Bank, also listed on the DFM, posted a first half profit of 826 million dirhams. This was minus 33% year on year, and the second quarter contribution was also down strongly year on year. Income from Islamic financing and Islamic investment actually grew strongly during the half by 23%. However, this was offset by 240 million dirhams worth of impairment losses, a year on year 500 million reduction in the share of profit from associates, income and investment. General and admin expenses also remained steady. Customer deposits increased by 7.7%, underwriting an attractive loans to deposits ratio of 86%, well below the UAE average of around 110%. Annualising net profit for 2009, we get a forecast PE ratio of 4.9 times at a discount to the DFM average. Therefore, we believe that for investors with a higher risk tolerance, Dubai Islamic Bank offers solid share price upside, given that DR profitability, although bad, has begun to improve quarter on quarter. Islamic income remains stable. Equity and property market write-downs appear to also have stabilised, and the bank trades on a very cheap PE multiple. Further, the bank has demonstrated that it has a strong ability to draw on customer deposits with which to fund loans growth, so we expect that its market share will rebound strongly in 2010. Engineering company Drake & Scull, listed on the DFM, has announced that it is bidding for 700 million dirhams worth of contracts around the Gulf, including UAE, Qatar, Sudan and Libya. This is versus the company's current backlog of 2.9 billion and its market cap of 1.9 billion. The second quarter result was solid, posting a net profit of 90.1 million dirhams, up 15% year on year, which is a good result for the company in its maiden year of being listed on the DFM. Trading on a forward PE of 8.3 times, we see upside to the share price during the second half based on new contract wins and cost gains flowing through from a reduction in staff costs and also input costs to the engineering and services functions. So just to recap for news on this 6th of August 2009, we've talked about Aramex's result and it's a buy. Arabtec's result, we think it's a long-term buy. DP World, first half volumes, we believe the stock is a buy. Emaar's first half result, we think that it is an equal weight pending further disclosure on several items. Dubai Islamic Bank, we think that it is a buy with a speculative rating. And Drake & Scull, which we think is a buy as a stock with a smaller market cap than Arabtec and arguably a stronger growth profile. So that's all for this week. Happy investing, dom arigato and sayonara!